Hello friends, this is Afaqahmed. In this lecture, we will be studying business plans and importance of capital to entrepreneurship. Business plans are all about walking the walk. People who write business plans also do more stuff, and doing more stuff such as researching markets and preparing projections increases the chances of entrepreneur will follow through. Many people have business ideas over course of their career, but often these ideas never come to fruition or they get lost amidst our daily obligation. Another important way in which business plans can provide tangible help is by aligning everyone in an organization with the vision and strategy going forward. And this in turn has important ramifications on corporate executive satisfaction. Formal strategic planning process play an important role in improving overall satisfaction with strategy development. The role can be seen in the different responses. The 79% of managers who claimed that the formal planning process played a significant role in developing strategies and were satisfied with the approach of their companies, compared with only 21% of the respondents who felt that the process did not play a significant role. Many entrepreneurs will eventually need to raise outside capital to grow and develop their businesses. In many experiences, business plan is a crucial tool in maximizing the chances of raising money from external investors. A well-written plan not only helps investor understand your business or your vision, but also shows them that you have taken the time to carefully assess and think through the issues your business will face, as well as more detailed questions surrounding the economics and fundamentals of your business model. In this module, we'll be learning preliminary planning, capitalization and finance, legal system, strategic business development, and business operation. First, we'll start with preliminary planning. Business plan is a blueprint of step-by-step procedure that would be followed in order to convert a business idea into a successful business venture. Objectives of business plan covers to give direction to the vision of entrepreneur, to objectively evaluate the future prospects of the business, to monitor the progress after implementation of a plan, to seek loans from financial institutions, to facilitate the decision-making process, to persuade others to join business, to identify strengths and weaknesses present in the internal environment, to identify opportunities and threats in external environment, to assess the feasibility of the business. In preliminary planning, first we'll see preliminary investigation. In order to create an effective plan, an entrepreneur must review available business plans, draw key business assumptions on which plan is based, scan the environment for strength, weaknesses, opportunities, and threat, that is SWOT analysis, seek professional advice wherever required, and conduct a functional audit. Next is idea generation. It involves the generation of a new concept or product or service or value addition to an existing product or service. The idea must be such that satisfy the existing demands and future demands of market. Now the sources of ideas. First is the consumers. We can generally take the ideas from the consumers, like the consumer generally gives a suggestion through the suggestion sheet, suggestion box. Next is existing companies. Third is research and development. Fourth is employees. In this part, the employees may also suggest you the best ideas. Next is dealers and retailers. Because the company never contact to the customers directly, and generally customers convey their ideas, their demands to the dealers and retailers. Next part is method of generating ideas. First is brainstorming. Here you can collect or ask your intellectual people come together and have a brief discussion, that is called as brainstorming. Group discussion also you can take. Then data collection through questionnaires, that is surveys. Invitation of ideas from professionals, value addition to existing product and service, market research, import the ideas from products launched abroad. Next is commercializing inventions. Screening the ideas is done to identify practical ones and eliminate impractical one. The most feasible and most promising idea is collecting and selected for further investigation. Next is environment scanning. The internal and external environment must be analyzed to study the prospective strength, weaknesses, opportunities and threat of the business. An entrepreneur must be collect information from the formal and informal sources in order to create and understand the supportive and obstructive factors related to the business enterprise. Here it is divided into two different parts. First is external and second is internal. The sociocultural appraisal, assessment of values, beliefs and norms of particular society. Second is the technical appraisal, existing technical know-how and available tech to convert this idea. Economic, consumer price index, inflation, consumption pattern. Like we generally need air conditioners during summer season, and we generally need raincoats in rainy season. Economic appraisal, it assesses the economic environment in terms of consumer price index and consumption pattern, per capita income and sometimes balance of payments. Next is demographic. It involves an assessment of overall population pattern of particular region, variables like age, education, income pattern, sex, occupation, distribution, etc. Helps in identifying size of target market. Next is government appraisals. It assesses various grants, legislations, policies, incentives, and subsidies formed by the government. Next is internal environment. First is availability of raw material, availability of various machines, tools, and equipments required for production. Means of finance and assessment of opening, maintaining, and operating expenses. Assessment of present potential and future market. Assessment of cost, quantity, and quality of human resource required. Next is feasibility analysis. Feasibility analysis is done to find out whether the proposed project will be feasible or not. Various variables that are studied include market analysis. It is conducted to estimate the demand of proposed product in the future, estimate the market share of the proposed product in the future. Next is technical or operational analysis. It is conducted to assess the operational ability of proposed business. It is very important to find out the cost and availability of technology. Under technical analysis, the data is collected on following parameters: material availability, material requirement planning, plant location, plant capacity, machinery and equipment, plant layout. Last is financial analysis. The financial feasibility test is carried out to assess the financial issues related with proposed business. The following estimates have to be carried out. First is cost of land and building, cost of plant and machinery, preliminary cost estimation, provisional contingencies, then working capital estimates, cost of production, sales and operation, and production estimates. Based on above analysis, the following projections are made: break-even point, cash flow statement, and balance sheet. Next part is drawing functional plans. If feasibility plans give a positive indication, a draft business plan is formulated. It involves preparation of following functional plans. First is marketing plan. A marketing plan lays down strategies for marketing a product or service which can lead to success of business. These strategies are made in terms of marketing mix, that is 4 P's: product, price, place, and promotion. Next is production or operation plan. A production plan is made for a business involved in manufacturing industry, while an operation plan is made for business involved in service industry. It includes strategies of following: location and reason for selecting location, physical layout, cost and availability of equipment, machines and raw material, list of suppliers, distributors, cost of manufacturing and running operations, quality management, production scheduling, capacity and inventory management. Next is organizational plan. It defines the type of ownership, that is, it could be single, proprietary, partnership, firm, company, private limited or public limited. It also consists of detail about the organization structure and norms guiding the organization culture. Next is a financial plan. It indicates the financial requirement of proposed business and finishes the following details: costs incurred in smooth running of all the financial plans, projected cash flows, projected income statement, projected break-even point, projected ratios, projected balance sheet. Next is human resource plan. It consists the details of following: manpower requirement, recruitment and selection, compensation, organization structure, wages and salaries, budget and remuneration, etc. Next is project report preparation. It is written document that describes step by step the strategies involved in starting and operating a business. It is prepared when environmental scanning has been done and feasibility studies have been carried out. Evaluation and review control in order to keep up the dynamic environment and successfully face global competition, a business must be continuously evaluated and reviewed. It is necessary to periodically evaluate, control and review a business to keep with technological changes and introduce changes in the business strategy.
Next part is capitalization and finance. The word capitalization can have many meanings in small business. It's used in accounting to describe the cost of equipments that's written off as depreciation over time. It also describes the conversion of retained earning into capital and the conversion of an operating lease into capital lease. In this case, through capitalization refers to generating money that allows a business to open its door. It's also called funding, backing, capital investment and owner's stake. How you capitalize your startup can have long-term effects on your company's success. Funding startup expenses, inventory and operation is the challenge for many business owners. It's important to understand and explore the options available to entrepreneurs along with each method's risk and rewards. Now in this capitalization finance, we'll be discussing on projected financial statements and startup cost. In this slide, we can easily understand the startup cost. Here we have mentioned the liquidity in terms of dollars. Now first column is startup expense and second column is estimated cost. First we have taken the equipment which cost around $10,000 to $1,25,000. It is just we have taken this example to understand the startup costs. Then next is incorporation fees, that is under $300, that is the legal fees. Third is office space. It generally varies $100 to $1,000 per employee per month. Inventory is nothing but your stock which cost 17 to 25% of total budget. Marketing will cost 0 to 10% of total budget. In certain companies, they may extend this marketing cost up to 25%. Next is website. To design the website, it will cost around $40 per month. Next is office furniture and supplies, 10% of total budget. Utilities, about $2 per square foot of total office space. Next is payroll for the employees, which will cost around 25 to 50% of your total budget. Professional consultants, that is required for taxes and other things, which may cost around $1,000 to $5,000 per year. Insurance, average $1,200 per year. Taxes are variable, but 10 to 11% corporate tax rate can also be considered. Travel is variable and shipping, which is also variable. So in this table we can easily identify and we can easily come to know that how the startup cost is playing vital role and how to adjust your total budget. Next part is projected financial statements. Projected financial statements take into account past financial trends, market conditions, possible changes and management expectation to arrive at a future finance picture. Accounting alone only looks at past financial data, that is, the expenses you have already made will also be considered. In the business world, pro forma or projected financial statements are typically used to focus on certain figures such as sales or profit. Now I would like to ask one question to you all. Why projected financial statements should be regular part of your accounting? You guessed it, planning. Projected financial statements help you plan for future. Given the many different decisions and scenarios you are faced with every day, projections help you decipher between them all. This allows the decisions you do make to be backed by numbers and financial analysis. Let's think of this way. When you make a major decision in your personal life, how do you go about choosing the best option? First, you examine possible options and their corresponding outcomes. From there, you choose the options with most favorable results. You need to have this sort of analysis as a part of your business decision making as well. Projected financial statements is the way to review your possible outcomes before making a decision. While no projection is perfect, having one mitigates the risk of uncertainty and losses. In this slide, we will get the detailed contents of projected financial statements. First is financial statement, second is projected financial statement, income statement, projected income statement, objectives of financial statements, balance sheet, projected balance sheet, objectives of projected balance sheet, cash flow statements, projected cash flow statements, and objectives of cash flow statements. Let's see one by one. In this slide, we will see the first part, which is income statement. An income statement or profit or loss account is one of the financial statements of a company and shows the company's revenues and expenses. It is helpful to know about company's financial condition. Income statement focuses on 4 key items: revenue, expenses, gains and losses. It does not cover receipts, money received by the business, or the cash payments or disbursements, money paid by the business. It starts with the details of sales and then works down to compute the net income and eventually the earning per share, that is EPS. Essentially, it gives an account of how net revenue realized by the company gets transformed into net earnings, profit, that is profit or loss. Key takeaways for income statements are: an income statement is one of the 3, along with the balance sheet and statement of cash flows, major financial statements that reports company's financial performance over the specific accounting period. Next is net income. Third is total revenue is the sum of both operating and non-operating revenues, while total expenses include those incurred by primary and secondary activities. Third is the revenues are not receipt. Revenue is the earned and reported on income statements. Fourth is an income statement provides valuable insights to the company's operations, the efficiency of its management under performing sectors and its performance relative to industry peers. In this slide, you will be able to easily understand the net income statement. It is given for Excel Sports, which is a shop maybe, for quarter ended on 30th September 2018. Revenue, first column is revenue, expenses, gains and losses, net income. Second column is particular, third column is the amount, fourth column is sum, that is the total amount. For merchandise sale, they have earned the profit of 25,800. Revenue from the training, different trainings they might be conducted, that is 5,000 rupees. So total revenue is 30,800 rupees. Expenses during that period is procurement cost 8,000, wages 700, rent 1,000, interest paid 500, transportation 300, utilities 150. Total expenses are 10,650. Gains, the income come from the sale of van, which is 2,000. So losses are settlement costs of consumer lawsuit, which is 800. So the net income, here you can say the revenue plus gains minus expenses plus losses. So whenever you will add, here you can add 30,800 rupees, that is total revenue, plus 2,000 rupees from this side, that is 30,800 plus 2,000 rupees, minus total expenses, that is 10,650, and again we have to subtract 800 rupees, that is losses. So we will be able to get 21,350 rupees, and this amount is called as net income. Now we'll see the objectives of net income statement. To ascertain the earning capacity or profitability of the business, to know the solvency of an organization, to ascertain the financial strength, to know the capacity of payment of interest and dividend, to know the trend of an organization, to provide useful information to the management. Now in this slide, we'll understand the balance sheet. The balance sheet is one of the three fundamental financial statements and key to both financial modeling and accounting. The balance sheet displays the company's total assets and how these assets are financed through either debt or equity. It can also be referred to as a statement of net worth or statement of financial position. The balance sheet is based on fundamental equation, that is assets equal to liabilities plus equity. As such, the balance sheet is divided into two sides or two sections. The left side of balance sheet outlines all of the company's assets. On the right hand side, the balance sheet outlines the company's liabilities and shareholders' equity. On either side, the main line items are generally classified by liquidity. More liquid accounts such as inventory, cash and trades payables are placed before illiquid accounts such as plants, property and equipment, and long-term debt. The assets and liabilities are also separated into two categories: current assets, liabilities, and non-current, long-term assets and liabilities. Next is projected balance sheet. The balance sheet is a statement which prepared to know the value of assets and liabilities in end of a period. Now we'll see the objectives of balance sheet. The main objectives of balance sheet is to assess the financial position of the firm. It is a list of assets and liabilities of the firm
on specific date. The short-term and long-term financial position of a firm can be obtained from the analysis of balance sheet. Balance sheet is rightly said to be a mirror reflecting the true value of assets and liabilities on a particular date. Please have a look on self-explanatory balance sheet shown here. Next is cash flow statement. A cash flow statement is a financial statement that provides aggregate data regarding all cash inflows a company receives it from ongoing operations and external investment sources. It also includes all cash flows, outflows that pay for the business activities and investments during a given period. A company's financial statements offer investors and analysts a portrait of all transactions that go through a business, where every transaction contributes to its success. The cash flow statement is believed to be the most intuitive of all financial statements because it follows the cash mode of business in three main ways: through operations, investment, and financing. The sum of these three segments is called net cash flow. These three types of sections of cash flow statement can help investors determine the value of company stock or the company as a whole. Cash flow statement is a financial statement that shows how changes in the balance sheet accounts and income affect cash and cash equivalents, and the break the analysis down to operating, investing, and financial activities. Objectives of cash flow statement: measure of cash, generating inflow cash, classification of activities, prediction of future, evaluation of future cash flow. Now we will see three different categories of cash flow statements one by one. First is cash flows from operations. This is the first section of the cash flow statement and includes transactions from all operational business activities. The cash flows from operations sections begins with the net income, then reconciles all non-cash items to cash items involving operational activities. So in other words, it is a company's net income but in cash version. The section reports cash flows and outflows that stem directly from company's main business activities. These activities may include buying and selling inventory and supplies along with paying its employees their salaries. Any other form of the outflows such as investments, debts, and dividends are not included. Second is cash flows from investing. This is the second section of cash flow statements and is a result of investing gains or losses. This section also includes cash spends on property, plant, and equipment. The section where analysis took to find changes in capital expenditure. When capex, that is capital expenditure, increases, it generally means there is reduction in cash flow. But that's not always a bad thing, as it may indicate the company is making investment into its future operations. Companies with high capex tend to be those that are going. And last is cash flows from financing. The cash flows from financing is the last section of the cash flow statement The section provides an overview of cash used in business financing. It measures cash flow between a company and its owner and its creditors, and its source is normally from debt or equity. These figures are generally reported annually on companies' 10K report to shareholders. Analysts use cash flows from the financing sections to determine how much money the company has to pay out via dividends or share buybacks. It is also useful to help determine how company raises cash for operational growth. Cash obtained or paid back from the capital fundraising efforts such as equity or debt. It is listed there as are loans taken out or paid back. When the cash flows from the financing is positive number, it means there is more money coming into companies than flowing out. When the number is negative, it may mean the company is paying off debt or making dividend payments and stock buybacks. Next part is legal section and insurance. Successful startups are ones that are driven by passionate entrepreneurs who are focused on building unique solutions that deliver customer delight. While it is very important to have a strong focus on customers and the market, it is equally critical to have a good understanding about basic laws, rules, and regulations that are applicable to start a business. Entrepreneurs must keep with new development in local, state, and federal business law. Laws can be changed quickly, so you must adapt quickly and risk losing competitive advantages. If you are too busy to keep your eye on legal landscape, hire a qualified business attorney to help you so you can keep doing what do you best, running your business. It is money well spent. Hiring an attorney with knowledge in your area of business can do more than just keep you updated on changes in law. They can also help you make informed business decisions. No matter the size of your business, you must conform legally by complying with all applicable licenses, zoning ordinances, and all other legal regulations. One of the first issues you should address is choosing the legal structure for your business. This is not a decision to be taken lightly. The structure you choose will have legal and tax implications. You should consider the size and location of your business, risk and liabilities, and your tax requirements. Be sure you are informed about your opinions and options and choose legal structure that best suits your business and financial situation. The legal business structure you choose will determine how little information you need to put into the organization and the management section of your business plan. The section will ask you about your company's organization structure, ownership information, and board of directors. This section can be quite simple or sole proprietors and quite complex for corporations. Here in this slide, I have given the detail of legal details with different types of businesses. In first column, you will see legal details, that is the registration, legal status, member liability, number of members required, transformability, taxation, annual statutory meetings, annual filings, existence or survivability, foreign ownership. And here in second column you will see proprietorship, that is types of business, partnership, limited liability company, private limited company. So first I will give two different rows of operation for legal details, and later you can easily understand it because it is completely self-explanatory table. For legal details, first registration. For proprietorship, no formal registration required. For partnership, registration is optional. You may take or you cannot take if you want. Limited liability company has to be registered with the Ministry of Corporate Affairs under the LLP Limited Liability Partnership Act 2008. Private limited company has to be registered with Ministry of Corporate Affairs under section of Companies Act 2013. Second is legal status, not recognized for proprietorship, not recognized as the separate entity, and promoter is personally responsible for all liabilities. For partnership, not recognized as a separate entity, and promoters and personally responsible for all liabilities. But for limited liability company LLP, it is a separate legal entity. The promoters of LLP are not personally liable towards LLP. For private limited company, it is separate legal entity. The promoters of the business or the company are not personally liable towards the company. So this is how you can easily understand this table of legal system for different businesses. Here again you will find different legal details with business types. Please have a look on it. Next is entrepreneur law and its relevance. Nurturing a new business includes many things. One such stepping stone is knowing basics of the startup laws. An entrepreneur solves a problem faced by people. For this, he or she should make sure that every move is precise. This is very important. But don't forget that it should be considered legit in the eyes of law. Now next is startup basic law. First is basics of accounting and tax related laws. Running any kind of business means that one has to pay taxes to the central or state government or local bodies. Choosing the type of venture, it is indispensable to analyze and ponder upon practicality, visibility, sustainability, aptness, and related profit. Third is labor laws. Productivity of employees and ultimate success of startup are dependent upon how happy your employees are work for you. Next is Securities and Exchange Board of India, that is SEBI. Keeping a track of various updated regulations issued by SEBI will assist in managing the various stages of running a new business, including fundraising. Fifth is corporate governance. Running knowledge about corporate governance will help a budding entrepreneur to effectively manage and formulate further expansion plans. Sixth is IT law. Knowledge of IT laws will be protecting your privacy are not only very common but extremely important too. Contract laws and dispute resolution. A business survives on contracts, therefore fundamental knowledge of regarding contracts, arbitration, mediation, conciliation can smoothen the progress of successful business. Next is constructual property laws, timely IP audits, filing the accurate trademark, copyright, patent claims will not only protect your business but increases profit too. Next is entrepreneurship and business. Here we have on right hand side three different arrows: start a new business, buying existing business, and new product development. First we'll start with start a new business. It is a self-employment, an organization created with primarily intention to give jobs to the founders, that is sole proprietor operations. Entrepreneurship, all new organizations. Startup, a temporary new organization created with intention to be bigger, at least have employees. Small business, an organization that is small, few employees, and may or may not have the intention to be bigger. Small businesses are either services or retail operations like grocery stores, medical stores, trade people, bakeries, and small manufacturing units. Next is buying existing business. Building your own business is hard work. That is why many entrepreneurs choose to buy an existing business rather than starting from the scratch. Buying an existing business will allow you to evaluate its cash flows and operating expenses, giving you a better idea how much investment capital you will need. When you start your own business, these numbers are much more difficult to estimate, and investors consider startup businesses higher risk than existing ones with operating histories and proven track records. The key elements of buying businesses are: first, formulation of clear objectives, that is homework, search and contact; third, evaluation of target, sometimes called due diligence; and fourth is negotiation and purchase. And last point of this complete module is new product development. Next is new product development. New product development is the process of bringing a new product to the marketplace. Your business may need to engage in this process due to changes in consumer preferences, increasing competition, and advances in the technology, or to capitalize on a new opportunity. Innovative business thrive by the understanding what the markets want, making smart product improvements and developing new products that meet the exceeds their customers' expectations. New products can be categorized into two parts: products that your business has never made or sold before but have been taken market by others. Product innovations, second is the product innovation created and brought to the market for first time. They may be completely original products or existing products that you have modified and improved. NPD, that is new product development, is not limited to the existing businesses. New businesses, sole traders, or even freelancers can forge a place in the market by researching, developing, and introducing new or even one-off products. Similarly, you don't need to be an inventor or master new product development. You can also consider purchasing new product through licensing or copyright acquisition. Here in this slide, I have given a beautiful presentation in terms of the data. Here I have given one table, which is first column is for serial number, second is for type, and third is purpose or aim. First type is extension of existing product line. If one company is rolling out a new product, we have to extend their potential, or you can extend their existing product line. The purpose or the aim is to strengthen product line, improves product quality, reduce cost. Second, use of existing material, technology, and equipment to develop products with new applications. The purpose is to use current core knowledge, technology to develop a new product. Glass lab equipment makers develops glass tableware. Third is development of a product that utilize the same sales and distribution channels as existing product. Their purpose and aim is to use of current channels for new avenues. Development of a film by camera manufacturer. Developing a new product that have absolutely no connection with existing product, that is expansion and acquisition of market and technology. If you find my videos interesting, please subscribe my channel and share the videos for the needy people. Thank you very much for listening.